Most people believe that the Federal Reserve was founded by Congress in some sort of official capacity, after public debate and decision. But the reality is more subdued. In the winter of 1910, on a distant island off the coast of Georgia, a handful of bankers and politicians gathered on a private train using code names. They disappeared from public sight, meeting in secret and mapping out the plan for what would eventually become the most dominant monetary body in the United States. This is the Economic Archive, and today we explored the truth about the Federal Reserve and how it was founded not in the public eye, but in secret, created through clandestine coordination. It was the product of men who knew that systems of control function best when they are not well understood. But what were they trying to control, and why did they want to do it out of the public eye? To understand how this came to be, we must examine what came before. In the 19th century, the banking system in America was a mess. There were over 1,000 banks that issued their own forms of currency. There was no central body to control credit, provide liquidity during panics, or underwrite the value of the dollar. The nation experienced booms that turned financial busts in 1837, in 1857, in 1873, in 1893, and again, in a big way, in 1907. Panic, silence, crash, repeat. But this last panic was the last straw. It was fueled by over-leveraged speculation, the failure of trust companies, and the collapse of bank stocks, and it swept the nation overnight. Markets plummeted. Depositors scrambled to withdraw. Loans were withdrawn. Businesses closed. The federal government was powerless to act. But this time, something new would come out of the crisis. It was not a politician who came to the rescue. It was J.P. Morgan, the private banker. He called an emergency meeting of financiers in New York, forced banks to cooperate, injected his own money to save faltering businesses. He temporarily steadied the financial system. But the mere fact that one man could hold the key to a sound financial system proved how fragile it was. What would happen if one man chose not to act? The people and Congress were in agreement on one thing. The financial system could no longer rely on big shots who would improvise rescue operations. It needed a central brain. But the construction of this central brain would not be public. In November 1910, 6 men boarded a train. They used pseudonyms. No other person accompanied them. No reporter knew where they were headed. Their destination was Jekyll Island, a private resort owned by the elite. For 9 days they worked on a unified plan for a national reserve system. Among them were Senator Nelson Aldrich, Treasury Assistant A.P. Andrews, and top executives from Morgan Rockefeller and Kuhn, Loeb. So what did they actually manage to create during this week of secrecy? It wasn't a conspiracy. It was elite networking at its finest. Their plan was called the Aldrich Plan. It consisted of regional reserve banks for private banks and a fixed board for the control of monetary flow. Only 3 years later, in December 1913, this plan quietly passed through Congress as the Federal Reserve Act. However, the date of its passing was no coincidence. It was signed into law by President Woodrow Wilson just before Christmas, when most of Congress was already home for the holidays. No public campaign, no national referendum, a system that would affect every American paycheck. The very basis of modern central banking passed without notice. What happened next would change everything about the flow of money. On the face of it, it was a decentralized system. In reality, power accumulated swiftly in Washington. The Federal Reserve Board started its gradual ascendancy as America's central control room for finances. Although intended for market stabilization, its framework also accumulated an unprecedented amount of financial power. The Fed could now control interest rates, shape the supply of credit, supervise commercial banks, and function as a lender of last resort during times of crises. But who was watching the Fed? Was anyone? During the Great Depression, the Fed's reluctance to inject liquidity drew criticism. Historians suggest it contributed to the worsening of the Depression. Others suggest it was hamstrung by its lack of policy options. What happened next was no restriction. It was an extension. The Fed adjusted. With President Roosevelt's separation of gold from private vaults, the Fed's new set of tools started to take shape. Open market purchases, interest rate policies, liquidity injections. The United States entered the era of centralized control through monetary engineering. However, this financial power carried an unexpected signal. Stability would now be ensured not by gold, but by trust, by interpretation, by a committee. In 1971, President Nixon closed the convertibility of the dollar to gold on an international level. The dollar was a pure fiat system. The Fed was now managing a floating currency that would need constant attention. But how do you manage a system of confidence? You talk carefully. Transcripts of meetings were delayed. Language was opaque on purpose. Words like measured pace and modest growth became instruments of psychological persuasion. Behind those words, trillions of dollars were in motion, and hardly anyone noticed. The 2008 crisis thrust that persuasion into the spotlight. When Lehman went down, the Fed didn't debate. It acted. Zero interest rates, trillions of dollars in quantitative easing, asset purchases, and crisis loan facilities. These did more than help banks. They saved the system, but not everyone was in agreement on how. Was the economy saved or reprogrammed? During the COVID-19 crisis, the Federal Reserve moved with unprecedented speed. Purchases of corporate bonds, support for mortgage-backed securities, releases of statements that calmed the world before Congress even convened. The Fed had become more than a crisis manager. It had become a forward controller. At the Economic Archive, we think that the history of the Federal Reserve reveals more about the nature of power in the modern world than most people realize. Its quiet origins, its deliberate opacity, its centralization without election. This is where power is now. It shapes policy, moves markets, determines inflation, wage pressures, and housing access. But how many people even know where it is? If this story has given you a new insight into how monetary systems are created behind the scenes, then please support the Economic Archive by liking this video, subscribing, and sharing it with someone who still thinks that financial systems are fully democratic. And let us know in the comments. Is it right that unelected boards get to control the global economy? Because the next thing they say may move more money than any vote ever has.